In 2023, credit card debt in the United States surpassed $1 trillion for the first time. This is the Cash Files, Case 8. How did a payment tool turn into a system of permanent debt? In the 1950s, everyday purchases still relied on cash and checks. Carrying cash required planning, and checks had to be verified by hand. Banks kept limited hours. Paying wasn't instant. In 1958, Bank of America introduced the Bank Americard in California, a card designed to make spending easier. Other banks adopted the model, and the structure behind Bank Americard eventually evolved into Visa. Competing institutions formed a rival network that would later become MasterCard. Over time, the model settled into four core players. The issuing bank extended credit and took on the risk of non-payment. The network authorized and processed transactions electronically. The merchant accepted the card and paid a fee for the convenience of immediate payment, and the consumer used the available limit, deciding how to repay the balance. The model removed steps and pushed payment into the future. The card gradually established itself as a tool of convenience. Then in 1978, the Supreme Court's decision in Marquette National Bank versus First of Omaha changed the landscape. Banks were allowed to charge the interest rate of the state where they were headquartered, not where the customer lived. That meant they could base operations in more flexible states, like South Dakota and Delaware. In practice, it cleared the way for higher interest rates. At that point, the cap stopped holding the system back. Without an effective limit, rates could rise. In that environment, the minimum payment became structurally important, keeping accounts active while extending the life of the debt. If the balance is paid in full, no interest accrues. But as long as a balance remains, interest is calculated daily, keeping the debt in motion. Over time, credit cards began to shape access to borrowing itself. At the same time, miles, points, and cashback programs expanded. They're funded partly by merchant fees and partly by interest paid by those who don't pay their balances in full. That's how, in 2023, credit card debt crossed the $1 trillion mark. That figure depends on balances that aren't fully paid off. Credit cards make spending easier, selling convenience in the present. The purchase takes seconds. The debt can last for years. This was the Cash Files. Case is now closed.